Hello and welcome to Morning Brief Market Sunrise. I'm Ramzan Karmali, live from Yahoo Finance's studios in London. It's Thursday, 14th August. Coming up on the show, Bitcoin rises to a record high and the new crypto IPO bullish soars on its debut. We ask, is China back? And we revealed a stock that's climbed over 80% yesterday and looks set for more today. So grab your coffee and let's own the morning. Well, we kick off three things in the world of crypto. Bitcoin hit a record high, breaching the $124,000 mark for the first time ever. It has eased back since, as you can see. So what's behind this latest surge? Not only did it get a lift from the equity rally yesterday, which saw consecutive record highs for the S&P 500 and Nasdaq, but it also got a lift from the fact that there is increasing expectations for easier monetary policy from the Fed. Adding to all of this is that we have a much more crypto-friendly regulatory climate in Washington under the Trump administration. And on top of all of this, there's been sustained institutional buying. In fact, one analyst at IG believes that if Bitcoin breaches 125,000, it could propel the world's largest crypto asset to $150,000. And Bitcoin isn't the only cryptocurrency that's flying. Ethereum prices are also closing in on near record levels as Wall Street grows increasingly bullish on the world's second largest cryptocurrency by market cap. And we're sticking with crypto for the next thing you need to know. On yesterday's show, we told you that the crypto exchange operator Bullish was about to launch on the New York Stock Exchange. And let me tell you, it was a pretty impressive debut. The offering price was set at $37, but that stock continued to climb. It finally settled to close over 80% higher at $68, and it looks set for more gains today. The company's debut follows from the likes of Figma and Circle and serve as the latest sign that the IPO window remains wide open after a few challenging years for investors. And finally, today we get some economic data that could potentially offer insights into inflationary pressures and the state of the labour market. Investors will be eager to see if July's Producer Price Index report will fall in line with the CPI data, which has boosted sentiment this week. Economists are expecting a slight uptick in PPI from the prior month. If that comes to fruition, then it should likely confirm that US firms are absorbing much of the costs associated with higher tariffs. PPI taken together with the July CPI number should provide a reasonable estimate on where the Fed's preferred inflation gauge, the PCE price index, will fall for the month. That comes out on August the 29th. Now, initial jobless claims for the week ending August 9th will also be released in the morning. Economists are expecting a slight decrease from the previous week. Well, all these numbers will be closely watched by policymakers at the Federal Reserve and should give them a better idea of the state of the economy. One analyst we spoke to, though, on Yahoo Finance isn't so optimistic about the outlook.
Well, we're thinking it could, on a significant economic slowdown with the Fed pretty much battling with the White House, and I expect the last 9 months or so of Powell's term are going to be increasingly an outright war. Then what I think will happen is we're looking at 5,500 as a mid-teens correction for the S&P 500. Now, you could certainly see 5,750, a fairly mild 10% type correction. But that's where our numbers are coming at. And we look at it a lot of different ways, some complex ways, such as economic profits versus enterprise value to invested capital, which is actually very close to where it was in late 1999 before that bust. So there are a number of risks that a overly bulled up market, particularly the investors, retail especially, that they're not really cognizant of. I mean, if you think about the demographics of the market and all the people coming into it, if it were that easy to go straight line and make money and quit your day job, then people would have done it a long time ago. It's a very difficult market. It's like going down a mountain road with switchbacks and no guardrails. And so I just would caution people not to be overly bulled up if it's cash that you need within the next year.
So given that backdrop, Barry, that you've spelled out there, how do I want to be positioned then in the market, Barry? What are you telling clients?
Well, if you think about the Fed, they're the guardians of what's called the neoliberal order, right? They've always believed, and they've written many, many papers on the fact that they believe that you can only have really good economic growth if you have really low inflation. You have a president that wants to run the economy pretty much red hot. He's willing to have the inflation, but only if the nominal growth, the real plus the inflation of the economy, is super strong. So that's a major battle. And then the interlude, while those two fight it out, red hot versus the low inflation is the only way to grow mentality at the Fed, you go with defensives, value-oriented defensives like beat up healthcare, some of the staples like waste companies, utilities. That would be probably a better place to be as they duke it out here in the late third and then early fourth quarter.
Okay, like many market watchers these days, we are asking a big question today. Is China back? Chinese stocks have gained ground in recent months, powered by slightly improved activity in the world's second largest economy. And guess what? Lower interest rates. The CSI 300 index is up roughly 15% from its April low following Trump's tariff announcement on Liberation Day. And trading volume in China is now up. One sector that's driving the rally, Chinese tech. Alibaba, Tencent, and just this morning, JD.com all posted strong results. JD.com is sometimes dubbed the Chinese Amazon, and as you can see here, its US listed shares are up by more than 1% in pre-market after it posted revenue of nearly $50 billion for the quarter. Weibo, Chinese social media platform, also beat expectations this morning, and the stock jumped on the news. As you can see here, it's up more than 1.5%. Finally, Taiwan's Foxconn, the world's largest contract electronics maker and manufacturer of the iPhone, also topped forecasts, posting high AI demand and a 27% increase in profits. Now, there's a lot to say about the risks surrounding China tech, especially as Washington and Beijing continue to negotiate tariffs and a new trade framework, while they keep jostling for dominance in chips. And Chinese tech companies are also facing some significant challenges. Just this morning, the Financial Times reported that OpenAI rival DeepSeek will delay the release of its new AI model after it failed to pull it off by using Chinese chips made by Huawei. So for now on this front, the US still seems to be in the lead. Okay, we're heading for a quick break now, but we'll be looking more closely at what's driving the markets to these record highs that we're currently seeing. Stay with us on Market Sunrise. Welcome back to Market Sunrise. Well, let's take a quick check on the futures market. US futures are hovering around the flat line this morning after the stocks extended their rally yesterday, pushing the S&P 500 and the Nasdaq to consecutive record highs. So what's behind this surge? Well, Jared Blikre has this analysis in the latest Stocks in Translation.
The Nasdaq and S&P 500 are smashing records almost every day. And on today's Stocks in Translation, we are asking a simple question. What is driving the biggest stocks right now? Is it earnings or valuation? We need to begin with a few definitions that deal with stock fundamentals. These are derived from financials that Wall Street analyzes. So just stick with me because in a minute, I'm going to tell you how each of these concepts relate to each other. First, we have forward earnings per share, or forward EPS, which is just the street's best guess of profits for each share of the company over the next 12 months. When the outlook improves, it rises. When Wall Street cuts its estimates of future profits, it falls. Next up, we have the forward PE, or price to earnings ratio. It is the stock price divided by that forward EPS that we just talked about, and it tells you how many dollars investors are willing to pay for $1 of expected profit. When the multiple rises, that's called multiple expansion. And when it falls, that's called multiple compression. Here's how they fit together. Share price equals forward PE times forward EPS. And here's an example. A $10 stock with $2 of forward EPS trades at a 5 times forward PE. The $10 stock price equals the 5x multiple times the $2 forward EPS, and that right there is the whole engine. Now let's see it in the wild with Nvidia. This chart goes back a decade and it shows the Nvidia stock price in white and its forward earnings per share in green. You can see how they more or less have tracked each other over the long term. The stock price and profit expectations are closely linked over these time frames. Right now, at the right edge of the chart, price is pressing to new highs. Meanwhile, forward EPS is also near its highs. That means fundamentals are broadly supportive, and the extra gap that the market is paying, that's a multiple or a re-rating, as we say. Now, Amazon, it tells a different story. Through 2023, price and forward EPS, they were climbing nicely together. Then in 2024, forward EPS dropped sharply, and you can see that toward the right of the chart. As that green line fell, the stock still pushed to fresh records, but that was a re-rating thanks to that multiple increasing. Lately, it has struggled to clear that old price peak, and without a turn higher in profit estimates, that price rally is harder to sustain. So what's driving the big five? We put forward EPS change on the vertical axis here and forward PE change on the horizontal, all in a grid. In the top left, both of our variables are up. Profits are rising and investors are paying a little bit more. And at the top right, this is when upgrades leave. Expected profits are rising while the multiple cools. Bottom left, that is a re-rating. Expected profits are down, but investors are expected to pay more. And finally, in the bottom right, that is a D-rating. We see both expected profits and the multiple are under pressure. So let's take a look at how these concepts are playing out in the 5 biggest stocks in the S&P 500. Here at the top are the first 3. We see that Nvidia is currently in a re-rating. The multiple jumped while forward EPS, it slipped a touch. Our 2 levers for Microsoft and Apple are both up, with modest estimate improvement and a smaller multiple lift for each. Now, here are the other 2 stocks. Alphabet has both of its levers moving up, but the multiple is doing most of the work. This is a heavier re-rating. But Amazon is in the worst position of the group, caught in a derating cycle. Profit estimates have been heading down, as we saw in the chart a minute ago. And also, Amazon's multiple, it's cooled. It needs stabilization in forward EPS to regain its upward momentum. So putting it all together now, here's what to watch next. First, pay attention to the forward EPS trend. Are analysts raising their profit estimates or are they cutting them? Second, the forward PE direction. Is the multiple expanding or is it compressing? Third, how are each of the names migrating around the grid that we showed before? Toward the upgrade lead in the upper left or towards the derating in the lower right? These 2 levers, they explain most big stock moves not only in these stocks, but all equities, at least over the long haul. But it's important to remember that day to day, there are many other factors that will send stocks up or down. Bottom line, long-term price moves come from 2 places, expected profits and what investors are willing to pay for them. The cleanest path for a stock is when profit estimates take the baton from the multiple. And tune in to the Stocks in Translation podcast for more jargon-busting deep dives. New episodes can be found on Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcasts.
Amazing analysis, as always, there from Jared. Okay, we're heading for a quick break, but stick with us. I'll have the answer to the question, which stock surged more than 80% yesterday and is leading the way in the pre-market? Time for our trending tickers, and I told you about a stock that was up over 80%. What was it? Well, it was Webtoon. Disney has reached an agreement with Webtoon Entertainment to host a variety of its iconic IPs, such as Star Wars and Marvel, on its platforms. Initially founded in South Korea, but now listed in New York and based in LA, Webtoon specializes in vertical scroll comics, primarily for viewing on mobile phones. Shares jumped over 80%, as I said, and continue to be positive in the pre-market. Webtoon has over 150 million monthly users and reported $348.3 million in revenue in its Q2 earnings in June, an 8.5% increase. It's also partnered with another favourite of mine, Crunchyroll, the anime streaming service, and DC Comics, the home of Batman and Superman. Moving on to a very different stock now, and one that's suffering this morning, Carlsberg. Shares of the Danish beer maker are down around 6.5%, dragged down by disappointment It's over 7% now, dragged down by disappointment from its half-year earnings. Carlsberg reported just 2.3% operating profit growth, below analyst expectations of 7.35 billion Danish crowns, and volumes dropped nearly 1.7%. Despite raising its full-year guidance, management warned that consumer demand is unlikely to improve through the remainder of 2025. Now, Carlsberg is the third major brewer to acknowledge struggles in recent weeks after AB InBev and Heineken. Expect further volatility in this sector as investors and consumers' tastes appear to shift away from established brands. Now on to Tempest AI. The startup backed by Cathie Woods and Nancy Pelosi has been rising in the past day and is now trading around the $70 mark. Tempest beat Q2 expectations and is riding the wave of renewed optimism around healthcare AI. Tempest is developing what it calls precision medicine systems to collect and analyze health data for the diagnosis and treatment of diseases. The stock is benefiting from being one of the largest positions in ARK Investments' portfolio. That's Cathie Wood's fund, and some analysts see it rising much further from here. And speaking of cutting-edge technologies that are making the buzz, quantum computing has been hitting the headlines this week as companies tout major advances in this field. D-Wave Quantum is one of the companies that have been getting attention. As you can see, the stock has nearly tripled in recent months. But how quickly are quantum computers going to become a reality? D-Wave CEO Alan Baratz answered the question on Julie Hyman's show here on Yahoo Finance.
There are a number of different approaches to developing quantum computers. Some of them will take longer to mature, some of them nearer term. At D-Wave, we provide what's called annealing quantum computers, and those are commercial today with companies like NTT Docomo or Ford Otosan or Pattison Food Group, all using us today to help benefit their businesses.
So for people who are interested in investing in something like quantum computing, what is the use case today for the computers that you're selling versus the next step and the step after that and the step after that?
Yeah. So I think about it in three phases: near term, medium term, long term. In the near term, there are a broad array of problems that we typically think of as business optimization problems. This can be anything from workforce scheduling to manufacturing plant floor optimization, even protein folding. And these problems can be addressed today with D-Wave's annealing quantum computers. And so the companies that I mentioned a minute ago are all using us for business optimization. In the medium term, I think that quantum is going to make a significant impact on AI and machine learning. Specifically, quantum computers are very fast and very energy efficient. And what this means is that all this rhetoric around AI requiring nuclear power plants and massive energy generation stations is likely not going to be required to anywhere near that level once quantum computers are a part of the training process.
But when is that?
I think that we may be able to get there within a year or two.
Really?
This is medium term. We're not talking about long term. In fact, at D-Wave, we announced a few days ago a first step toward this by introducing an AI machine learning platform that developers can use to start investigating how to use quantum for large language model training. But we still have a ways to go on developing that technology and bringing a complete product to market. And then longer term, we're talking about almost unimaginable things like designer drugs, where we could develop a drug that would address just your specific set of ailments.
So, for people who are investing in stocks like yours and others, obviously you've seen crazy gains in the stock that are exponential. What do you think is still sort of the biggest misconception, or what kind of education do you have to do for investors and potential investors?
Well, there are quite a few different quantum computing companies that are pursuing different approaches to developing their systems. And so I think you really need to take a look at which of these companies are talking about delivering products 5 or 10 years from now, and which of them are delivering products in the near term. I'm very proud of the fact that we are delivering products today that are creating value. And so I think that that's a really good place to start. But there is huge long-term opportunity as well.
And I should mention the opportunity today. You guys have been growing a lot, but you're still relatively small in terms of the revenue that you bring through the door. And so how quickly do you expect that to ramp up? At some point, is there sort of a tipping point?
Yeah. So there are two components to our business model. One is a service-based component, what we call quantum compute as a service. And for commercial companies that really just care about leveraging quantum to get better solutions to their applications, quantum compute as a service is the ideal model. But it takes time to build a revenue base around that because it's a service-based business. It's a recurring revenue business. Goodness, more predictable revenue growth in the long term, but it takes time to build that base of revenue. We also sell systems. Now, we just started selling systems only about 6 months ago. We sold our first system to the Jülich Supercomputing Center in Germany. That is a very complementary model because it's to supercomputing centers, government labs, so not necessarily commercial.
Research-based.
More research-based, but it's near-term revenue recognition. As soon as we install and deliver the system, we recognize revenue up front. So I think the two will work together very well to allow us to build both near-term revenue more rapidly as well as that base of longer-term recurring revenue.
Okay, we've got some breaking news, some breaking earnings. We start with German sandal maker Birkenstock. It beat third quarter profit expectations today, helped by strong full price sales of its sandals and shoes, and said it was well placed to manage the impact of the 15% US tariffs on European imports. The company's shares jumped about 2% in pre-market trading, as you can see there, after it also stuck to its margin forecast for the year, despite a significantly weaker dollar. Now, Birkenstock, whose suede leather closed-toe Boston clogs sell at $180 each online, has seen the firm demand over the past several quarters as wealthy shoppers showed few signs of resistance to price increases. Sales grew 16% in constant currency terms in the Americas during the quarter after 20% growth in the previous 3 months. Results are also out from John Deere, the world's biggest farm machinery maker. It has again pared its outlook for full-year net income as growers are yet to start spending with grain prices under pressure. The builder of the iconic green and yellow machines used to plant and harvest crops estimated 2025 net income between $4.75 billion and $5.25 billion. That's down from a forecast in May. Shares are down over 6.5% in pre-market, as you can see. The farm machinery sector has been expected to bottom out this year, but a record American corn harvest and uncertain crop demand amid President Trump's trade wars is injecting uncertainty into that timeline. Sentiment among grain and livestock producers eased earlier this month as crop prices declined. Okay, let's get a final check on the futures. We start in Asia, and it's a bit of a mixed picture here. Notice, though, the Nikkei down quite a bit there. Perhaps some profit taking after it hit record highs earlier this week. Moving on to Europe, and it's a positive story in the main, apart from the FTSE, as you can see, it's just slightly below the flat line there. There's some UK GDP numbers that came out earlier, were better than expected, but still shows that growth in the UK is slowing. And finally, let's have a quick check on the US markets as well. And it's pretty much flat across the board. Remember, the Nasdaq and the S&P both hit record highs, consecutive record highs yesterday. Investors there, though, will be watching out for the PPI data and the jobless claims numbers that come out later today very closely, and that could switch those reds into greens. Okay, and that is all we have time for. That's it for Market Sunrise for this morning. Stay with Yahoo Finance for continuing live coverage of the markets and your money all day on streaming and online. Keep an eye on oil today ahead of the scheduled Trump-Putin meeting in Alaska tomorrow. Coming up next, join Julie Hyman ahead of the market open on Morning Brief, and we'll also have an interview with the CFO of Cisco. I'm Ramzan Karmali. Go own the morning.